the lights are very bright, so we barely can see the lines.
We're all
I think they're meant to be either intimidating or meant to torture. You know how in prisons they have these like bright lights and super loud music? I think this is a version of that. I'm just waiting for the music to kick in.
Somebody will start the clock, right? There you go.
Yes, please start.
Okay. We have to wait till the clock starts. Oh, there you go, the clock starts. Hey, thank you so much for showing up right after lunch. But this is going to be a very exciting panel. The topic, so just so you know, you're in the right place, it's the first recession of the digital credit era, a challenge and an opportunity. So I'm just going to do introductions first. I'm Manish Gupta. I'm a founder and CEO of Corridor Platforms. And before I started that, I was at American Express for many, many years in many capacities, one of them being the Chief Credit Officer of the consumer business through the last Great Recession, which by the way was 13 years ago. So, so I can add some of my own perspective. Corridor Platforms, which what I run now, is a decision workflow automation platform with embedded governance. And its main aim is how do you let regulated entities start using advanced analytics, machine learning, big data to kind of get ready for digital modeling. But equally importantly, how do you convert those things into strategies and rules that can be tested and executed in production very, very quickly. Because as we'll see, digitization is almost synonymous with real time, and almost all banks and regulated entities need to get more nimble. So that's about me. I'm going to let the panel introduce themselves. Maybe Human, if you can start from there.
Hi everybody, Manish, thank you for hosting us as well as the Fintech Nexus folks here. Very excited. Human, Lending Point. Our company's been in existence for about 7 years. All of us, we are former banking and in the payment world. The consumer focuses on consumer loans. We give loans, we don't need it. And we focus on personal loans, point of sale, and small business lending. Data is at the core of everything we do, and happy to be joining this circle here tonight.
William?
Good afternoon. Thank you, Manish. Human, Ash, and Gavin, I'm delighted to be sharing the stage with you. Hello, everyone. My name is Murali Bolaswar. I run decision sciences on the consumer side at Citi. My team's mission statement is to deliver faster, wider, and deeper data-driven insights to achieve superior decisions and material financial outcomes. Why that mission statement is important to me is because it reflects our aspiration to not just take a functional lens, but to take responsibility to drive end-to-end innovation that manifests itself either in material financial outcomes or in the speed and clarity with which decisions are made. And it's again a delight to be here.
Ash?
I'm Ash Gupta. I'm the chairman of Corridor Platforms now and involved in a wide range of startups after my retirement from American Express, where I worked for 42 years as its chief risk officer, as its chief credit officer, and president of risk and information management of the company. And we were involved right from the era of using credit bureaus to decision science to AI and everything related to big data. And this discussion is an extension of that experience.
Thank you, Ash. Gavin?
Manish, thanks so much for moderating and for preparing us. Not that we weren't prepared, right? My name is Gavin Harding. I lead an experienced fintech team in the Western U.S. It's good to be here.
Hi, thank you so much. And thank you for sponsoring the panel. So let me just introduce the topic. So digitization is something that's really ramped up over the last decade, but certainly post-pandemic, it has accelerated in banking, in credit, on the deposit side. And what it means for the consumer is one choice. Now, consumer now has the ability to fulfill their needs by many people competing with multiple offers, and then they have the ability to choose which one they want and which one they accept and which one they reject. So that's an important concept, which is, I think, very new, and I think the panelists will talk about it. The second is speed. It's almost all is real-time instant gratification, but also speed to move. So consumers, as you can know, can now move deposits, but they can also move credit and loan and assets. So there's a completely different paradigm. And what does that mean to people who are giving loans and managing loans is, I think, what we will discuss. Overlay on it, and when we talk about the first recession, I want to clarify, I mean credit recession. We're not calling it the economic recession, etc. But I think loss rates eventually are normalizing and going higher, and I think most will say we are already in some sort of loss recession. So if you overlay the new phenomenon of choice and speed, and then you're entering into a recession after 13 years, I think there are going to be some very interesting learnings that are going to happen in the next year or two. And it'll be very important to get the experience of this panel and how do we kind of tackle that. So I think the main takeaway that we would like from the panel is what are the new challenges which you may or may not have thought of because of digitization, and how do you meet that challenge, especially as recession or credit recession comes up and it hopefully doesn't surprise us. And so I'm going to start asking questions. One of the, and I just wanted to, there's an elephant in the room that I wanted to make sure that we clarified. I mean, there's already somewhat of a crisis going on with regional banks. This is not a panel that's going to go deep into the liquidity crisis or the deposit crisis. And there's been a lot of conversations already, but there are important parallels to draw, right? The first one I already said. Choice is actually, and the speed to move is central to some of the issues that are happening on the deposit side. Those are the same things can happen on the credit card, loans, mortgages, etc. side. People can move, so we should reflect on that. The other thing is deposit interest rates are climbing, and the asset side is going to be equally important in kind of managing not only duration, but flexibility to manage profitability. So that's a very relevant topic as we think about the asset side. And asset valuation and is central and key even to this crisis. So, so that will also should be covered in this discussion. So Gavin, I'm going to start with you. I think being the economist in the room. So, credit recession, as I'm calling it, when we were managing credit, it used to happen every 4 or 5 years on the clock. So we were very disciplined in kind of growing and then getting pulled back and growing and learning, and there was consistent data, etc. Now, if it happens, it's going to happen after 13 years, and there's a lot of people in the room who have kind of built their business without going through a recession. So just give us some insight into what they should be prepared for.
All right, so we've got 3 or 4 hours to mention. Okay, so let's start with this. Let's start with this. I want to share good news. IMF today, right, said that the U.S. will have the fastest growing economy this year in the G7. That's good news. I got an amen. Fantastic. 1.6% growth. That's good news. Unemployment steady. That's good news. Inflation below 5%. That's good news. The reason I'm saying this is because we are in an extraordinarily complex, dynamic environment. Okay? I think our takeaway here is we don't see the environment ever becoming less complex, ever becoming less fast-moving. Okay? So the question is, how do we engage with the environment? How do we understand it? How do we make sense? And then what do we do? Right? That's kind of where we are. So let's think about this in just very fundamental terms. Data. Do we have all the data we need? No, we don't. Does the old data work? Yes, it does. But the takeaway is and. The old stuff works and we need new data. And it's more data. And it's more analytics. So as the environment accelerates and becomes ever more complex, our response to it and our engagement with it needs to match. And then the one thing I'd like to add at the end of this, which is really, it's a little difficult to figure out what's going to happen here, but we have a lot of people that have never been through this type of environment. In the industry, right? Founders and startups. On the regulatory side, so we've got this super fast-moving environment. We've got a need for deeper, richer data, and we've got a whole lot of people that are figuring out how to engage with it. That's, I think, where we are for now.
Well, next year is a man who's been through at least 4 recessions. And so I'm going to at least ask him, and maybe Ash, just to add to it, if you could think about the question of what does digitization and choice do to a portfolio that's new, and then add on to what does that mean in terms of how do you manage that in a recession, that'd be great.
Yeah. Well, first about data, that if I'm trying to build the probability of risk or probability of something using last 18 months of data, I realize that the future and past are not totally in sync. Like the rear view mirror from the car and the forward view are not aligned right now. Relatively, we might be doing well. So the question is the intelligent use of data in predicting the future. In my last recession, suddenly during the recession, the homeowners became a lot more riskier than renters, which was never the case in my prior 30 years of work. And so the question is, as they say, utilization of data in a very wise way, in a very nimble way, to be able to relate to the current environment for a better future. Let me talk about digitization a little bit. Digitization is a good thing because it creates opportunity for everybody to join the financial system, and it creates liquidity for a wide range of people. But digitization creates some of the largest volatility and the biggest probability of negative selection in the system. Negative selection is very simple, that if your technology, you're a company, your technology is not well advanced, you book 100 people in my MX Life, 100 people applied for the card. If we approve them, they all took the card. Now what happens is, if we approve 60, 15 will take my offer. Other 45 will take offer from somebody else. And if the other guy has better technology than I do, then they will take away the better 45 out of my 60. And my write-off rate would look way higher than my model predicted. And the central question for me as a lender is, how am I going to improve my technology and science in a way that I can be as good or better to the next guy? And how am I going to have it so nimble that it can work in a more changing environment? The good part of digitization, Manish, however, is that data is easily and equally accessible to everybody. Thanks to you guys, Credit Bureau is accessible to everybody. Thanks to Plaid and Finicity, bank data is accessible. Thanks to many data vendors, all sorts of other data is accessible. So small and big guys in this world can advance their technology equally fast. But you have to want to do it, and you have to do it, and it's a necessity to do it. The second thing you'll face different in a digitized recession, Manish, is that in my whole life, denominator was never a problem. Whatever the AR did for us, it did for everybody else. We only worried about the credit write-off in the numerator. As you've seen in the volatility in the deposits, you'll see massive volatility in the denominator as well, that in a changing environment, people will want to take your good AR away from you. So you'll feel both the challenge in the numerator with the rising write-off, as well as the challenge in the denominator with rapid shrinkage in the denominator. And therefore, volatility would look much larger than it did, and the loss could climb at a rate that you did not forecast. So those are some insights for me. It's not, by the way, a panic statement by any stretch. It's a statement of knowing your risk, because that creates the biggest opportunity in this world.
Thanks. Anybody can jump in at any time if you want. But Murli, I do have a related question, and then you can add on. So Murli, for full disclosure, I've been working with Murli for some time. They are one of our largest clients. And I do know that you're very, very focused on advancing technology and analytics to serve the consumer. And as Ash said, loyalty has a different meaning now. So not even from the risk side, it's just serving customers. So maybe you can reflect on some of the advancements that you're doing to really get to know the customer and how do you serve them in this kind of new paradigm.
Thank you, Manish. As I think about that question, I'm reminded of what Ash was sharing with me. He said, you know, the way to sort of paraphrase what's different today than ever before is the relationship with the consumer and the customer has gone from a monologue to a dialogue. And the phrase that I'd like to offer to everyone in this room that I think is absolutely critical is this notion of radical empathy. What is radical empathy? It's being able to use the power of your data of every interaction and transaction to separate noise from signal and to be able to infer your customer needs in a latent needs in a proactive way and engage with them in ways that they might not necessarily have expected. Why is that important? I think it's important because consumers are increasingly obviously driven by their expectations on every facet of their lives. And no longer will they be willing to accept a different or a lower bar from their financial services provider relative to other facets of their lives. One of the things that we've done that I'm really proud of is we've actually stitched together something called a customer analytic record at Citi. And what the customer analytic record does is it stitches together as many as 2,500 interactions and transactions at a single customer view. And that now allows us to have multifaceted applications of that capability, including certainly there's implications for KYC and such, but most importantly, it allows us to, within the firm, shape the culture of data-driven curiosity because we built a low-code, no-code platform on top of it that we call Correlation Hub that allows different functional employees to engage with the data and ask questions of the data in ways that can inform and guide their decisions. So the theme really is around contextual, granular, and time/speed of being able to translate every interaction and transaction into some meaning as and when appropriate, and to be able to mirror that back in ways that enrich and develop more mutual engagement with the consumer.
Hey, Murli, one of the things that, one of our experience was that customers in the digital world expect you to know what you're supposed to know about them. So, for example, when I have a Costco customer, and they want an American Airlines product. They don't want you to fulfill the entire application. The first question you should ask is, what's your Costco number? And whatever login is there. And once you have that, the way you have stitched the data, everything is known, and the next question is, what card do you want? Maybe you need some KYC knowledge. So customers are more and more looking for a very smart
Seamless, yes.
smart system. And in my world, I used to say that in which you tap but never type. That you could be driving a car and filling an application, that it should be so simple. And you guys have done some amazing work in that. So can you speak a little bit about it?
Yes, so one of the things that we've been able to do, I'll give you sort of one simple example. In the height of the pandemic, we were all sort of struggling with call centers and response times and such. One problem statement that we were able to tackle through that lens was to be able to take a customer's digital journey and to be able to preempt their need to call the call center by translating that interaction and inferring that friction that the consumer was experiencing and containing that within the digital channel. So this notion of sort of real time and the ability to anticipate what comes around the bend in terms of a customer need, and to be able to try and mitigate that pain point was something that we worked toward, and with some good amount of success in the height of the pandemic when all the call centers globally were shut down.
Thanks, Manish. So I think eventually we'll also talk about how you can take large banks and make them more nimble, etc. as you do it. But we have Human, who's Lending Point, one of leading fintech lenders out there. So you all certainly have other issues like when consumers have choice, acquisition costs can be through the roof because you finally approve somebody and then they go away to a city or an Amex, and you have to really think about being slightly smaller. How do you really know your consumer? How do you be nimble? How do you be faster to kind of start winning and growing, which you certainly have done. So maybe reflect on that, Human, and how you're kind of using data and analytics and technology.
Yes, for sure, Manish. So, look, I mean, the reason why our company has the right to exist is because we solve customer problems. Consumer is, by the way, all companies, I get it, but we need to work extra hard because we're struggling. Consumers in this digital age, we believe there are kind of two core dimensions that you have to be very aware of, and things are changing. By the way, there is not one persona out there. There is not such a thing as an average customer, right? We really want to treat everybody as humans, okay, and personalize their experiences. That is at the core how we're thinking about this, and that's a big, big problem. The reason is simple. Most trade products that actually put you in a bucket, okay? You look like this, you go into grade A. You look like this, you go to grade B. You go to this bucket. We think that the next generation of products, there needs to be personalized at the end of the day. And it's very, very difficult to achieve that. Let me explain that. Ash mentioned earlier, consumers in this age, they expect you to know who they are, right? To be candid, I don't believe I'm competing against Amex or Citigroup. I'm competing against Amazon in this world, right? Consumer has 2 hours of free time a week. What I'm competing for to get their share of eyeballs in this process to make sure I can make a difference in the world. This is the world of digital we live in, because guess what? If they go on Apple, they can have access to Apple products. The big elephant to me in the room is kind of what Apple is doing right now, right? From a consumer experience, etc. We can argue if Gomez doing a good job or not. I don't know. I'm not that smart. I can't figure out. I mean, I let them be, but Apple is an amazing product. I don't know if you guys have gone through a digital experience of Apple credit card. It's unbelievable. I mean, by the way, I was one of the first few people who defaulted on them to experience the collection. By the way, I do, for the record, I probably defaulted on all lenders in the room because if I have a 550 FICO, my wife's tired of it because of collection process happening all the time. But it's true, by the way.
Not a successful entrepreneur.
That's what I do. We have a different phone line for collection calls. Nobody picks it up. But no, that's what it's. No, but I think consumer expected to know who they are. But number two, more important or as important, you need to be where the customer is. The word of embedded finance to us means know who the customer is and be where they are. Delivering that product in that digital format is very, very complex, right? Because there's so many different scenarios you can think about. I'll give you this very good example around how we view the world of digital. We are the partner of eBay. We're enabling small business lending in their ecosystem. The consumer comes, they go to the eBay seller dashboard, automatically, based on all the data, all the history, we're able to consume that data, customize the products, and bring it back to them. You know, this is what sounds easy, but it's not. You know, one reason for that is because this requires a multi-cloud platform. Okay, eBay doesn't want you to necessarily work with Amazon ecosystem. You need to have a different cloud ecosystem that you need to have. Your ecosystem that you need to have from a technology standpoint needs to kind of, this technology stack needs to be very, very different in a way that you kind of deliver that product. This is why the right to exist, and the best performance of that is the NPS of the consumers. If we don't achieve 85, 90 NPS because we're competing with those guys, you're going to be obsolete sometime in the future. So we have to invent. And you know, Tom Manish, I mean, lastly on the credit side, obviously credit is the second, besides the NPS, the credit performance. In this world, guys, it's so important. You need to test and control all the time. I'm sure we're going to talk more about recession, but test and controls, not from a product take rate, but how you manage credit losses in this process. It's just very important. You can get go deeper into that.
Maybe we should do that. By the way, can we put on the barcode so that the audience can ask questions? So that I'm happy to do that. So if you can scan this, and I'll start asking from there. But let's touch on this because this is a fintech conference. So the kind of advancements in analytics, data, technology, nimbleness, and speed. And we have two real practitioners, one a large bank who's advancing and has different challenges because of legacy infrastructure. Maybe you can comment on how you're thinking about advancing those, and are you trying to build them, what do you partner with, what do you keep? And then Human, maybe you can talk about how you are using this analytics and platforms, etc., as a new age lender. So maybe Murli, you can start.
Certainly, I'll just take 30 seconds to respond to that, Manish. Is at the end of the day, where does magic happen? Magic happens when you have a culture of curiosity that is connected with the data and the intelligence that can be garnered from the data, and then being able to translate that into a bias for action in terms of execution and realization of that end value. And I think about those first two, or first 1.5, if I say, that culture, that talent, and the people, and the environment that you create for curiosity on a day in, day out basis, that is irreplaceable. That's something that you've got to protect with your life because that's precious and that's invaluable. Data, most of it, probably 80% of the data that many institutions use is probably within the context of their interactions with their customers, so internal. That's a massive asset because you actually understand and mature your historic relationship with your customer infinitely better than anything else. And then when it comes to execution and platforms such as Corridor, which we've obviously got an enormous regard for me, it is mostly coming from the angle of leave that expertise to firms and entrepreneurs that bring that specific niche capability, that spend their days and their team's days thinking about how to solve for that one problem. That doesn't mean that that always exists. So where it doesn't exist, I believe absolutely in a build model, but where it does exist, my view is it's not about sort of ego, it's about core competency and expertise. Where do you want to lean into? And if I had my druthers, I'd absolutely lean into the first two parts of that three-part equation.
Cool. Human, you get a different angle. How do you kind of create technology, keep up to speed?
First of all, I'm so fortunate to work with great technology people. One of them's here, Frank. It's amazing. We keep up with this. We have to keep up with this. There's a lot happening out there right now. ChatGPT, we're still learning about it, but how this thing's gonna, create next generation of products out there. It's gonna there are a lot of interesting use cases. Like in our case, guys, the customer expects you to know that you need to test and control all the time, right? One of the things super important for us, for example, on the pricing side, is just make sure we have consumer level pricing, right? Not that we have a bucket of pool of customers that we can kind of put them in that bucket. We think that matters, right? From a technical terms, CPR, CDR curves, and personal loan business, kind of customizing that stuff. But at the end of the day, Manish, to us, it really comes down to test and controlling different channels. And these channels, by the way, they have different data sets. You need to consume these data sets, right? Obviously, with all the right compliance behind it, which is kind of right there for the right reasons. You need to kind of double down on that. You need to monitor that very closely. The channels going to create different kind of problems that you had not anticipated to start with. But you need to test and control, and you need to have platforms to which you can measure. I can tell you guys, every morning, and a lot of my colleagues know this, every morning we go through all the channel performances ourselves, right? Having access to live data, not data from yesterday, we can get live data, right? Test and control, measure all the time. All these things, you need to enable it. And your technology stack is extremely important how you do this, because you don't have the time to go take 3 months, analyze, come back. You need to analyze live in the system and go with it.
I've seen a bunch of questions come up, so I'm going to try to move and reflect on them. I think I saw a set, Ash, which were addressed to you. I think the theme generally is, recession can create fear, people can get paralyzed. That slows down the numerator. In the past, many people have done this. Now you're saying the denominator can also move because things can move around. So how do you, in the new kind of thought process, how do we manage through a recession? And I think you've always taught us that it is also a great opportunity. If people are freezing, if you're prepared, you take market share away. So maybe you want to just reflect on that. By the way, the questions are moving so fast that I'm missing questions. If we can just reach the screen, but maybe Ash, don't worry about the questions for now. Just answer this one.
One thing what I try to do is I just hang around in case your question was not answered. I try to provide a specific answer to a specific question. But when it comes to recession, the most important thing is pre-recession planning. Most companies that I'm involved with are doing some form of planning. They all feel that they have adequate plans, but I always feel that they're running fast, but they're not making progress fast enough. And therefore they will be very serious adverse surprise in the coming months, is my general assessment as I speak to people. Basics are that when you enter here, make sure you have adequate MIS to understand things, you have adequate liquidity, and adequate book capital. And if I was a financial institution today, I would stop buying a stock back right now. Not that anybody is listening to me, but that would be my single advice to a financial institution today. The question is, during a recession, what happens? First is that you need to have a monitoring mechanism like the way you described, but the capabilities have to be very nimble so that they can rest on top of existing capabilities and can be steered around more intelligently. This was an example with modifying for renters or modifying for certain industries if you're in a small business world, and building your capability and executing the nimbleness here is going to be central to good success. And people just say they're nimble, they're not nimble. Now when you come to opportunities, Manish, one of the biggest things you find in a recession is that asset values drop way faster than their true economic value. So some of the very large store brand portfolios in the last recession had a zero market, like zero premium over their base AR. And 6 months later, you could probably get 10% premium on them. So asset values drop, and as long as you have confidence in your capabilities and you have some level of capital and liquidity, that is the best time to buy. It also is a time of creating tremendous customer confidence in my life, Manish, is that confidence you earn from people when they are going through a tougher time is a confidence that they will stay with you for the rest of their lives. So designing very well thought out customer assistance programs that really work with them. And somebody calls me and says, I lost my job. So my answer to them is, well, that's was between you and your employer, but you have not lost relationship with me as a credit grantor. I'm still your family, and we'll work things out together in a way that works for you, in a way that works for us, and we'll come up to a mutual understanding that will be unique for you. And that customer will never ever leave. So that's the opportunity that I offer.
Murli, you wanted to ask?
Actually, if I may, I was looking at one of the questions about AI. If it's okay, could I take 30 seconds on that?
But to just give the question out.
Yeah, the question was, I think it was about, what is the role of AI in essence? And the only analogy, the best analogy that I could think of is you look at something and you see it through your naked eyes, then you might actually get a magnifying glass and you get to see more detail. Now you've got a microscope and you get to see an extreme level of granularity, except things are whizzing by at 1,000 miles an hour. So AI for me is about being able to adapt to a world where you have to understand risk and behavior and needs through the lens of that microscope, where you can understand things at a highly granular level and they're moving at lightning speed. That's the best analogy that I can give. So in many ways, the problems have not changed. The tools allow us to continue to challenge our thinking around asking and answering the questions more deeply than ever before.
One of the things that most of us are practitioners here, that AI is a central tool for good risk management now,
because computer capacity exists to execute on large data, cloud exists. But AI left alone right now, whether generative AI or regular AI, is not adequate to manage credit. I just urge companies not to become tech fin companies, just remain fintech companies. It's not technology driving finance, it's finance utilizing technology. Manish and I were together in the last recession, and it was mortgages. You saw larger the mortgage, the less risky a mortgage is. And this is since the mortgage inception happened. Except in the recession last time, the larger the mortgage, the more risky it got. And so the wisdom of your products, the wisdom of your service, the deep understanding of your people is critical. And AI, as you're describing, the microscopic tool should be thought of in conjunction with your business to drive the best outcomes forward.
So I think I'm going to add to that as a practitioner because I have gone through it for so long with Ash. This is a key takeaway because there are a lot of companies that have started relying on machine learning and AI as a critical tool of risk management, and they should, as Ash said. But in a changing environment, it can be very, very dangerous. And so most models, like in the last great recession when we were taking the consumer portfolio, cannot keep up with that speed. And certainly AI models can calibrate faster, that's a great advantage, but they can't calibrate fast enough. So for the most part, it then becomes human knowledge and experience and a lot of changes in testing and learning that Human said. So even when we were developing Corridor to kind of think about the next stage, there was equal emphasis, one on how do you take advanced analytics, but on top, how do you take rules and make them so that you can test and learn and change them in production very quickly, which is very, very tough for big banks to do in a government way. So maybe just talk about that a little bit. I know Human, again, for full disclosure, uses us, but how important is that to be nimble now? And I think it's going to be even more important, even for every bank, even the large banks, to kind of manage credit.
Well, I mean, this is my third recession. We think every recession is like a snowflakes. They're all different. Okay, they're all going to drive different outcomes. The drivers behind them is different. Right now, when you look at what the customer is, to be honest, one measure I use a lot to kind of monitor is customer debt servicing as a percentage of annual, their disposable income is around 9.5%. Every consumer recession that has happened in the past, this number had hit to over 12%, right? So it's still below 2019 right now, even levels. So when you look at a metric like that, you say, okay, everything's kind of okay, right? But I'm a credit guy. My job is to worry all the time, during the good times, during the bad times. Are we growing too much? Are we slowing too much, right? So you have to have data that can enable it. Reality with model guys is that it doesn't matter how much AI you throw at it, it's not going to go through a recession. Now, do you care about it or not? I'm working for a small company, so my own capital, my partner capital in this, so we have to worry extra hard about it because I don't have Uncle Sam kind of bail us out in this process, right? Very simple. So we have to worry, and we know AI not going to work, but there are other techniques that you can use to kind of do this. I think the diversification of assets are extremely important. Don't put all of your eggs in the same basket, right? There's certain discipline, but you have to, Ash's point, you have to start this way too early. There are other things you need to do as a company. You need to be profitable when you go to a recession, because if you couldn't make money during good times, during bad times, good luck, right? We have to work very, very hard to make sure we can achieve profitability. Diversification of access to capital markets. Last recession, I remember in September 2008, Ash, correct me, some people woke up and there was no more access to money for the big banks in the marketplace, right? We have to make sure diversification across the entire business happens all the time. And on the consumer fund niche, I think data is extremely important because you have to have a safety net behind your models at the end of the day. You can go backtrack and take your models, go to last recession, which we've done. Worked very hard to go to 2004 data, backtest all this stuff. But is it enough? No, it's not enough. So you have to kind of create multiple layers of protections in this process because we're in a credit business and you have to your job is to worry all the time.
Murli, Gavin, please add any. Gavin, a lot of questions on data and.
Well, so let's go back. So Ash, I know you both said the same thing in I'm going to paraphrase. You got to be as close to your customer as possible in good times and bad with all the data. One of the questions here is what's the priority in data? I think the priority is your internal engagement, your internal transactional behavioral data, number one, right? The overlay of kind of the mainstream data, if you like, number two, and then that alternative, specific, real-time data that answers particular problems. So it's a layered approach, but you absolutely have to start with your own data.
Your answer, ChatGPT would have never come up with that summary. I bet on human intelligence anytime, buddy.
But equally importantly, after doing that, being able to change and adapt and take action quickly, and then learning and then moving. I think that's going to be the game.
It's the dynamism, and what I appreciate about Corridor is being able to track when are the sands under your predictions shifting, and how are they shifting, and how do you track that, and how do you react to that in a much more dynamic way, because speed of change. If there's one thing we've learned even more so in the last few weeks in our sector, it's that speed and perception can have, you know, fundamental institutional defining, altering impact. So grateful for that, and I think that's
Time's up. So I think there are lots of other questions, but I'm sure this room has got another session in it. Is that correct? So I'll just ask the panelists if they could step outside a little far from the door so that the other session can start. But then anybody else, say please ask the question.